Welcome to Market Monday from the investment team in the trust department at the First National Bank. Kicking things off, we're going to examine economic data points that are coming over the next 2-week period, and they are significant. Starting off with the Federal Open Market Committee's meeting minutes, which normally aren't considered that big of a deal. They are scrutinized by traders and investors. However, now, because of the way economic data points have been coming in, some strong, some weak, there's a lot of doubt as to what the Fed's course of action is going to be. Investors and traders are looking at what is the Fed thinking, what was the debate, which is released in these minutes, and where are they likely to go based on what they're talking about, because it does have implications for whether rates are going to remain stable for a while, whether they're going to eventually start cutting rates. We don't think that's as likely in the immediate horizon as other outlets and other analysts might think, but it is informative of that debate. And then we'll move into labor market and sentiment information, real estate information, what's happening with demand for durable goods. That's huge. Consumers, whether they're big corporations or whether they're individuals, don't tend to purchase big ticket items when they think that, the economy is starting to weaken. And we see here the expectation is for a decline of 0.7% from the prior reading of a rise of 2.6%. So that one will be interesting. And it determines, hey, if consumers are starting to slow down in demand, that has implications for equity prices. So we're watching that like a hawk. Same thing with sentiment. If sentiment's declining, consumer spending might be declining, and consumer spending being 2/3 of GDP, that could augur recessionary type forces in there. So we need to watch that. We'll actually get the GDP quarter-on-quarter numbers, and that's expected to show a slight deceleration from 1.6% growth on the prior reading down to 1.2%. We're not so sure that's going to happen based on a lot of the reports that have come out. We think that this could be a very hot number relative to expectations. Then we get the core PCE, which is the deflator, which is the Fed's preferred tool when they're gauging inflation, and it's expected to show a flat number here. In other words, 2.8%, the same as the last reading. And if that's the case, that does not give the Fed any reason to want to start cutting rates necessarily or hiking rates. That's kind of a neutral data point. We think this number is likelier than not going to still come in a little bit hotter than expectations, which would show, hey, the Fed cannot really cut rates at this point with any credibility. We'll get information again about construction, manufacturing, the factory orders. That's big. More durable goods. We get information on the labor market, non-farm payrolls being in particularly a strong report, one that we need to watch. They're expecting, when I say they, the consensus of analysts are expecting 225,000 new jobs having been created in the period of May, for last month. And now we're getting 175,000 was the prior reading, so this shows a strengthening labor market is the expectation. A 3.9% unemployment rate. This is worthy of note. 5% being the natural, long-term, sustainable rate of unemployment in an economy that's running at full capacity. That's a mouthful, but what it suggests is, labor markets are historically tight at the moment. And that is an indicator that the economy is stronger than expected. And then this consumer credit item that comes out on the 7th, that's worthy of note as well, because some of our research that was undertaken by our team, suggests that credit is maybe starting to slow down in its growth and maybe even starting to deteriorate in quality. There were some news mentions of rising defaults, and when we examined it, we found that indeed, in terms of revolving credit balances and credit cards, there's been an increase in defaults up to some relatively high, points. And worthy of note, worthy of concern points, and also in the auto loan sector as well. So we're watching this because what that suggests is the consumer is starting to become overstretched, and that would suggest that there's a future pullback in spending on the horizon. Now, all that out of the way, let's talk about the S&P 500, which is trading up at all-time highs. And, you know, why has that been happening? No one really knows. No one's going to be able to credibly tell you why that's happening. But we can give you a guess. And our guess is the story is about increasing profit margins, which would lead to increased earnings expectations, and earnings in the future being the main factor that stock prices are discounting into the present. You know, if you're expecting higher earnings, that naturally leads to higher stock prices. So looking at the consumer price index as a proxy for sales prices, that grew by 3.4% in the last reading. The producer price index grew by 2.1. So if we go back to this and say consumer prices are indicative of sales prices to consumers, while producer prices are indicative of input costs, that suggests that corporate margins are in fact rising. And all things the same, you know, assuming sales is the same in terms of number of units, you're going to make more per unit sold. Corporations are going to make more on their earnings reports. So that is potentially a big driver. You know, and let's go into rates, because this is important. The Treasury curve is telling us some interesting things. So year to date, this dotted line represents what the yield curve looked like on January 1st of the year, and the solid line is where we're at now. The gold line is where we were at a month ago, so they have come down a bit. But year to date, the 5-year note is up 62 basis points, 56 basis points on the 10-year, and the 20-year is up 50. So what does that mean? You know, it means something pretty significant, actually, because the Federal Reserve during this time frame has not hiked rates. So that suggests that the market participants in the bond market, who are among the most well-capitalized and sharpest, you know, in the world, are upping their long-term inflation expectations, because a government bond, a United States Treasury bond, has really only one component of risk in it, and that's the duration, which translated into English means, you know, what's the risk of losing purchasing power because inflation is high over the time that we're holding the bond. And with these rates being at, you know, basically 4.47 in the 5-year, 4.45 in the 10-year, and 4.58 in the 30, that suggests that relatively uniformly across the foreseeable future, in terms of decades, that inflation risk premium has gone up year to date. So we're watching that. Corporate bond curve has gone up commensurately, because corporate bonds tend to price off of the treasuries plus a spread that indicates what the corporate default risk is on any given bond. And you'll notice that this went up by less than what the government bond market went up by in terms of the yield curve. 5-year paper's only up 55 basis points, you know, 20-year paper's only up 44. And if you're looking at that, that suggests to us, you know, that the corporate default risk premium is actually shrinking a little bit, which would mean that market participants think corporate earnings are, you know, in fact getting stronger, and it supports the case made above. We're going to come back and close because, you know, everybody seems to be pretty excited, although worried, you know, as the market is hitting new highs. And there's an old adage that says the market climbs a wall of worry, so we're happy to see that. On the other hand, we're looking at the long term. So we're not going to make, you know, changes to a long-term investment plan that was put together with goals in mind based on what's happening in the short term in the markets. We're going to zoom out, and here's a 20-year period. This is more appropriate to the kind of goals we're looking at. And, you know, we had the financial crisis of 08 where the world was ending. We had COVID. We had a bear market in 2022. And, you know, none of this stuff is really meaningful over the long term when you zoom out. You know, we're trading up above 5,300. Back 20 years ago, we were trading down around 1,100. So, you know, that's the type of time frame that we're looking at. We want to maintain the long game. If you have questions about your portfolio, if you have concerns about the markets or the economy, reach out to us. We're happy to talk. And, you know, hope you found this video informative and useful. Thanks. Have a great day.